I'm going to be direct with you. If you're over 65 with $300,000 saved, you're probably being told the wrong things about what to do with that money. The conventional advice, the stuff you hear from most financial advisors, the articles in retirement magazines, the rules of thumb that everyone repeats, it's designed to keep you safe, and I understand why. At 65, you don't have decades to recover from mistakes. You need that capital to generate income, and you can't afford to lose 50% in a market crash. But here's what troubles me. In trying to avoid losses, most retirees are guaranteeing something worse. They're guaranteeing that their purchasing power will slowly erode. They're guaranteeing that their standard of living will decline. They're guaranteeing that the money they worked their entire lives to accumulate won't be there when they need it most. I'm Howard Marks. I've managed over $170 billion at Oaktree Capital Management. I've invested through 12 recessions, multiple market crashes, and every kind of financial crisis you can imagine. And what I've learned over 5 decades is this: the biggest risk isn't losing money in a bad investment. The biggest risk is not making enough money in good investments. Today, I want to show you how someone over 65 with $300,000 can realistically double that money to $600,000 in 5 years. Not through speculation, not through taking crazy risks, but through understanding something most investors miss: the difference between being conservative and being cautious. These are not the same thing, and understanding this difference might be the most important financial decision you make in retirement. Let me start by explaining what's wrong with the traditional approach to retirement investing. The standard advice goes something like this: take your age, subtract it from 100, and that's the percentage you should have in stocks. At 65, that means 35% stocks and 65% bonds. Some advisors will tell you to be even more conservative, maybe 20% stocks, 80% bonds. The logic seems sound. Bonds are safer than stocks. You're older, so you need safety. Therefore, you should own mostly bonds. But this logic falls apart the moment you examine what's actually happening in bond markets right now, in 2025. We've just lived through the most dramatic interest rate cycle in modern history. Rates went from near zero to over 5% and back down again. Bond investors who thought they were playing it safe got crushed. The Bloomberg Aggregate Bond Index, the benchmark for safe bond investing, lost over 13% in 2022 alone. Think about that. Retirees who followed conventional wisdom and loaded up on bonds for safety watched their supposedly safe investments decline more than many stock portfolios. They took the risk of bonds, and bonds absolutely carry risk, without getting the return potential of stocks. Here's what I've observed over my career. Most people misunderstand what risk actually means. They think risk means volatility. They think risk means your account balance going up and down. But that's not risk. That's just noise. Real risk is permanent loss of capital. Real risk is not having enough money to maintain your lifestyle. Real risk is your purchasing power declining year after year while you watch your safe portfolio fail to keep pace with inflation. When I look at a 65-year-old with $300,000, I don't see someone who needs to play defense. I see someone who potentially has 20 or 30 years ahead of them. I see someone whose money needs to work for 3 decades, not 3 years. And I see someone who's being told to invest as if they're going to die next Tuesday. The math is straightforward, but sobering. If you put $300,000 into a portfolio yielding 3%, which is roughly what you might get from a conservative bond-heavy allocation today, you'll have about $348,000 in 5 years. After inflation, which has been running around 3% annually, you'll have roughly the same purchasing power you started with. You won't have moved forward. You'll have treaded water for 5 years. But what if you need that money to actually grow? What if you want to travel while you're still healthy enough to enjoy it? What if you want to help your grandchildren with college? What if, and this is the reality most retirees face, your expenses are going to increase as you age, not decrease? This is where my strategy comes in, and it's built on principles I've refined over 50 years of investing through every market environment imaginable. The foundation is this: you need to own assets that can generate real returns above inflation, not nominal returns, real returns, returns that actually increase your purchasing power over time. And historically, only one asset class has consistently delivered those returns over long periods: equities. Now, before you dismiss this as too risky, let me explain how I think about structuring an equity-heavy portfolio for someone in your position. This isn't about buying meme stocks or chasing the latest AI hype. This isn't about speculation. This is about intelligent positioning in assets with genuine earning power. Start with the core understanding that drove much of Oaktree's success. You make money in investing by buying assets when they're undervalued and holding them until their value is recognized. The key word there is undervalued. Not cheap, not popular, undervalued. Right now, in 2025, I'm seeing opportunities in sectors that have been left behind in the AI and tech frenzy. I'm talking about businesses with real cash flows, real dividends, real assets, companies that are boring but profitable, overlooked but essential. Consider the energy sector, not the speculative, renewable plays that trade at 50 times sales. I'm talking about traditional energy companies that are generating massive free cash flow, paying dividends of 4% to 6%, and trading at single-digit price-to-earnings ratios. These aren't growth stories. They're cash-generating machines that the market has decided aren't exciting enough to own. Why does this matter for someone over 65 with $300,000? Because these companies are returning capital to shareholders through dividends and buybacks at rates that can compound your wealth while providing current income. You're not betting on price appreciation alone. You're collecting real cash while you wait for the market to recognize value. I've structured portfolios like this throughout my career. During the tech bubble in 1999 and 2000, when everyone was buying dot-com stocks at insane valuations, Oaktree was buying distressed debt and value stocks that nobody wanted. We looked foolish for about 18 months. Then the bubble burst, and those boring investments became the foundation of enormous wealth creation. The same principle applies today. When I allocate $300,000 for someone over 65, I'm thinking about building a portfolio that can generate a 15% annual return, not through speculation, but through a combination of dividend income, dividend growth, and modest price appreciation as value gets recognized. Let me break down what that actually looks like in practice, because 15% sounds aggressive until you understand the components. You start with a foundation of dividend-paying stocks yielding 4% to 5%. These are companies in sectors like utilities, consumer staples, telecommunications, and healthcare. They're not going to double overnight, but they're not going to zero either. They generate cash, they pay dividends, and they increase those dividends over time. That 4% to 5% yield is your baseline return. You're collecting that in cash every year. If you reinvest those dividends, and you should, you're buying more shares, which generate more dividends, which buy more shares. This is the power of compounding that most people understand intellectually, but don't fully appreciate in practice. On top of that dividend yield, you layer in dividend growth. Quality companies don't just pay dividends, they increase them. A company paying a 4% dividend today that grows that dividend by 6% annually is essentially giving you a 6% raise on your income every year. Over 5 years, that compounds significantly. Then you add the third component, price appreciation. Not wild speculation, but the natural tendency of undervalued assets to move toward fair value over time. If you buy a stock trading at 8 times earnings when the market average is 20 times earnings, you don't need the company to become a growth stock. You just need the market to recognize that maybe it should trade at 12 times earnings instead of 8. That's a 50% price gain right there. When you combine these three elements, current yield, dividend growth, and value recognition, getting to a 15% annual return becomes not just possible, but probable, assuming you're patient and disciplined. Now, I know what you're thinking. What about the risk? What if the market crashes? What if we have another 2008? These are legitimate questions, and here's how I think about them. First, understand that at 65, you're not investing for 1 year or even 5 years. You're investing for potentially 20 or 30 years. The average 65-year-old woman today will live to 86. The average man will live to 84. That's 2 decades. And if you're healthy and active at 65, you might have 3 decades ahead of you. Over any 20-year period in market history, stocks have never produced a negative real return. Never. Even if you bought at the peak in 1929 or 1999 or 2007, holding for 20 years made you money after inflation. The risk of stocks over long periods isn't losing money. The risk is not owning enough of them. Second, crashes happen. I've lived through enough of them to know they're inevitable. But here's what else I know. Crashes are temporary, while the earning power of quality businesses is permanent. During the 2008 financial crisis, the S&P 500 fell 57% from peak to trough. It was terrifying, but companies kept operating. They kept generating cash. They kept paying dividends, most of them anyway. And by 2013, the market had fully recovered. If you owned quality dividend-paying stocks through that period and you reinvested your dividends, you didn't just recover, you came out ahead because you were buying shares at depressed prices with your dividend income, and those shares generated even more income as the market recovered. This is the power of a strategy built on income and value rather than speculation and momentum. You're not dependent on the market going up every year. You're collecting cash flow regardless of what the market does, and you're using that cash flow to buy more income-generating assets when prices are low. Third, you need to structure your portfolio with liquidity in mind. This is crucial and often overlooked. You shouldn't have 100% of your $300,000 in stocks. You need a cash buffer for emergencies and for opportunistic buying when markets panic. Here's how I'd think about structuring that $300,000. Keep $30,000 to $40,000 in cash or very short-term bonds. This is your emergency fund and your opportunity fund. It's there if you need it for unexpected expenses, and it's there to deploy when markets sell off and create buying opportunities. The remaining $260,000 to $270,000 goes into your equity portfolio, but not all at once. This is important. You don't want to invest all your money on a single day and then watch the market drop 20% the next week. You want to dollar cost average into positions over several months, buying more shares when prices are lower and fewer shares when prices are higher. Within that equity allocation, you want diversification across sectors and individual positions. I'm not suggesting you put all your money into one or two stocks. You want 20 to 30 positions across different industries: energy, healthcare, consumer staples, utilities, telecommunications, financials, industrials. You want exposure to different areas of the economy so that weakness in one sector doesn't devastate your portfolio. But, and this is critical, diversification doesn't mean buying index funds and calling it a day. Index funds are fine for many investors, but they have a problem. They're market cap weighted. That means they give you the biggest exposure to whatever stocks have gone up the most. In 2025, that means you're heavily overweight expensive technology stocks and underweight everything else. What you want is intelligent diversification. You want positions in undervalued sectors and companies, not positions sized by how much the market currently loves them. This requires more work than buying an index fund, but it's also where the opportunity lies. Let me give you a specific example of how this plays out in practice. In early 2020, when COVID hit and markets crashed, energy stocks got absolutely destroyed. Oil prices briefly went negative. Energy companies that had been paying 6% dividends saw their stocks cut in half or worse. Everyone assumed these businesses were finished. But if you looked at the balance sheets, if you understood the long-term demand for energy, if you recognized that the world wasn't going to stop using oil and gas overnight, you saw an opportunity. Companies like ExxonMobil and Chevron were trading at prices that implied they'd never make money again. But they kept operating. They cut costs, they maintained their dividends or cut them temporarily and then restored them. And over the next 3 years, those stocks tripled or quadrupled. That's the kind of opportunity that exists when you're willing to buy what others are selling in panic. And it's the kind of opportunity that can turn $300,000 into $600,000 faster than most people think possible. Now, let's talk about the behavioral side of this strategy, because this is where most investors fail. It's not the strategy that's hard. It's sticking with the strategy when it feels uncomfortable. Markets will go down. Your account balance will decline. You'll see headlines screaming about recession and crisis and collapse. Your friends will tell you you're crazy for having so much in stocks at your age. You'll be tempted to sell, to move to cash, to wait until things settle down. This is the moment that separates successful investors from everyone else, because the best returns come from staying invested during the worst times. The best buying opportunities come when everyone else is selling. And the biggest mistake you can make is selling quality assets at depressed prices because you're scared. I learned this lesson in 1987. I was relatively young in my career, and I watched the market crash 22% in a single day. It was terrifying. I had clients calling me in panic, demanding to know what we were going to do. And I'll be honest, I was scared too. But I remembered something my mentor taught me. The stock market is a device for transferring money from the impatient to the patient. When everyone is selling in panic, that's when you want to be buying. Not because you know the market will go up tomorrow, You don't know that. But because quality assets are being offered at prices that make no sense. We stayed invested. We even bought more. And within 2 years, the market had not only recovered but reached new highs. The investors who sold in panic locked in their losses. The investors who stayed invested, or better yet bought more, came out ahead. The same pattern has repeated in every crisis since then. 1990, 1998, 2000 to 2002, 2008 to 2009, 2020. Every time, the investors who panicked and sold underperformed the investors who stayed disciplined and held on. This is why having a strategy built on income and value is so powerful. When you're collecting 4% or 5% in dividends every year, you're less likely to panic when prices drop. You can see the cash coming in. You can see the companies continuing to operate and generate earnings. The temporary decline in your account balance feels less frightening when you're focused on the income stream rather than the price fluctuations. Let me address another concern I hear frequently from retirees. What about taxes? If I'm generating all this dividend income and selling positions that have appreciated, won't I get killed on taxes? This is a legitimate consideration, but it's actually less of a problem than most people think, especially if you're thoughtful about how you structure your investments. First, qualified dividends are taxed at long-term capital gains rates, which are generally more favorable than ordinary income tax rates. If you're in the 22% or 24% federal tax bracket, your qualified dividends are likely taxed at 15%. That's a meaningful difference. Second, if you're holding stocks in a taxable account and you need to raise cash, you have flexibility in which positions to sell. You can harvest losses to offset gains. You can hold winners for over a year to get long-term capital gains treatment. You can be strategic about when and what you sell to minimize your tax bill. Third, if some of your money is in tax-deferred accounts like traditional IRAs, you can use those accounts for the highest yielding positions and use taxable accounts for lower yielding positions or for positions you expect to appreciate significantly. This is basic tax location optimization, but it can save you thousands of dollars a year. The key point is this: yes, you'll pay taxes on your investment gains, but that's a good problem to have. It means you're making money. And even after taxes, a 15% gross return becomes roughly a 12% to 13% after-tax return, which is still more than enough to double your money in 5 years. Now, let me be very clear about something. This strategy is not about getting rich quick. It's not about hitting home runs. It's not about finding the next Amazon or Tesla. Those are low-probability outcomes that require taking enormous risks. This strategy is about methodically building wealth through intelligent positioning in undervalued assets that generate cash flow. It's about being patient when others are impatient. It's about being greedy when others are fearful. It's about understanding that the market's job is to separate you from your money, and your job is to not let that happen. Over 5 years, if you can generate a 15% annual return on $300,000, you'll end up with approximately $600,000. That's the power of compounding. Year 1, you make $45,000. Year 2, you make $51,750 because you're earning returns on your returns. Year 3, it's $59,500. Year 4, $68,400. Year 5, $78,700. By the end of 5 years, you've more than doubled your money. But here's what's even more powerful. You've also built a portfolio that's now generating $30,000 a year in dividend income based on that 5% yield. That's $2,500 a month in cash flow that you can live on, reinvest, or use however you want. You've not only grown your capital, you've created an income stream that can support you for the rest of your life. Compare that to the traditional conservative approach. If you'd put that $300,000 into bonds yielding 3%, you'd have $348,000 after 5 years. Your income would be $10,440 a year. You'd be $252,000 poorer than with the strategy I'm describing, and your income would be less than half of what it could be. That's the cost of being conservative in the traditional sense. You're not protecting yourself, you're impoverishing yourself. Now, I want to address one final concern that I know is on many people's minds. What if I'm wrong? What if this strategy doesn't work? What if the market crashes and stays down? These are fair questions, and the honest answer is, I don't know what will happen. I never know what will happen. After 50 years in this business, I've learned that anyone who tells you they know what the market will do is either lying or deluded. But here's what I do know. Over long periods, stocks have outperformed every other asset class. Over long periods, quality businesses have generated real returns for their shareholders. Over long periods, patient investors have been rewarded and impatient investors have been punished. I also know this. The alternative, playing it safe with bonds and cash, virtually guarantees that your purchasing power will decline. It guarantees that you'll have less money in real terms 5 years from now than you have today. It guarantees that your financial situation will get worse, not better. So the question isn't whether this strategy carries risk. Every strategy carries risk. The question is, which risk do you want to take? The risk of temporary volatility and the possibility of permanent gains, or the certainty of slowly declining purchasing power? I know which risk I'd rather take. And after 50 years of investing through every kind of market environment, I'm confident in this approach, not because I think I can predict the future, but because I understand how markets work over time. Quality businesses generate cash, they pay dividends, they grow their earnings, they create value for shareholders. And when you buy them at reasonable prices and hold them with patience and discipline, you get rewarded. That's not speculation. That's not market timing. That's just how investing works when you do it right. So if you're over 65 with $300,000, here's my advice. Stop listening to conventional wisdom that tells you to play defense. Stop accepting the idea that your money should just tread water for the next 20 years. Stop settling for returns that guarantee your purchasing power will decline. Instead, build a portfolio of quality dividend-paying stocks in undervalued sectors. Reinvest those dividends. Be patient through volatility. Add to positions when others are selling in panic. And give your money the chance to actually work for you instead of just sitting there losing value to inflation. Will it be comfortable? Number. Will there be moments when you question this approach? Absolutely. Will your account balance go down sometimes? Yes. But will you have a realistic chance of doubling your money in 5 years and building a portfolio that can support you for the rest of your life? Also, yes. And that, to me, is worth far more than the false comfort of a conservative portfolio that's conservatively ensuring you'll run out of money. That's how I think about it. That's how I've invested for 5 decades. And that's what I'd do if I were in your position today.